It seems that it's more of an oligopoly for that resource. What does that mean exactly?
Well, it means that, and again, every energy metal is a little bit different. You can look at lithium with 3 or 4 primary producers globally, and with a sort of a well-supplied market right now for as far as the eye can see. And that, to me, says that it's very difficult for a junior mining company to break into that oligopoly. By definition, an oligopoly is just a small number of players, if you will, and they control the most important thing, which is price. And so, if they feel threatened, they can manipulate markets and manipulate price and snuff people out, for lack of a better phrase. And so you're seeing it in rare earths, you see it in lithium, uranium to a lesser extent. I think there are 7 or 8 companies that control about 85% of global production. So it just means it's very challenging for juniors to break into these markets that have, a very, very few number of players that want to protect their own interests and their profit margins.
So, with it being more difficult, does that mean we're going to see a lot more consolidation in these markets, or is that just?
Again, I think it depends on the energy metal you're looking at. I have a view on lithium and so on and so forth, but I have a view on uranium, and I think that uranium over the next, say, 3 to 5 years, you're going to see quite a bit of consolidation, and you're going to see that because it's a real contrarian play right now. You have the major producers, for example, like Cameco and Areva and BHP, and they need a much higher spot price than currently exists to justify expansion plans. And so they're going to continue on with their mining process, but they're going to have to replace those mined pounds eventually. And so that's why we think that near-term production stories in uranium are a very interesting place to be right now.
How about for juniors in uranium? Is that also something, the prospecting aspect of it, is there something there that can potentially hold a lot more weight in the uranium space?
Potentially, yeah. Obviously there are certain parts of the world where I would argue you would want to be with respect to uranium exploration and development, and certain places that you might want to avoid. And right now, obviously, what's going on in the Athabasca Basin in Saskatchewan is fantastic. There are a number of, people call them company maker type discoveries. And so, it's those types of companies that can make discoveries and push a project to a production decision that are going to be, I think on the radar, if you will, of the producers, the majors.
And as far as prices go for uranium, right now we're having a very low spot price. It's not very encouraging, as you mentioned. What about the long-term spot price? What's that look like, and how can investors looking to get into this use that as a guide?
Sure. Well, most of the contracts that are signed in uranium are signed on the long-term price as opposed to the spot price. And so right now the spot price is about $40 a pound, down from 70 when Fukushima happened. The longer-term price is closer to $60 a pound. And so that's really the number that you want to watch, and you want to watch for any upward pressure. But again, we think that the fact that a lot of the majors will ultimately have to replace those mined pounds means that they're going to also be going out and looking for junior mining companies that have low cost of production profiles that lower the majors' overall cost of production. And so that's why we think they're appetizing. So, everyone looks at, say, $40 to $60 a pound. If your all-in costs are below 40, then you're in business.
So I was talking recently with somebody here at the show, and they were talking about the ideal prices to be working at. What is an ideal price to be able to make money in uranium for a good?
Well, again, that it depends on the deposit. It depends on the type of mining. A lot of companies out there, for example, in Wyoming, are doing what's called in situ recovery. So, you're not building a mine. You're not building an open pit or an underground mine. So the capex for those types of projects is obviously much, much lower. There are obviously trade-offs with grade and so on and so forth. But again, right now, I look at the spot price when I try and figure out, what is ultimately kind of the bare minimum in terms of economics. You also have to be careful when you talk to various companies. They'll tell you what their cash cost per pound is. You want to know what the all-in cost is as well. And so right now, anything below $40 a pound all-in is something that's very interesting to me, regardless of the type of mining.
All right, well, that sounds quite good, especially if right now we're facing $40 spot prices. If you can be below that, then you're definitely laughing a little bit at the market.
I hope so. You know, you're in a good spot, but obviously it takes a lot more than that. It takes cash on the balance sheet and I think some savvy expertise in the space, and also the right part of the world. I mean, there's a big difference, you know, in being in the Athabasca Basin from a permitting perspective than, again, some of the other maybe less certain parts of the world. So,
well, that's all I had for today. Thank you very much for enlightening me on the energy markets. That was Chris Berry from House Mountain Partners. I'm Vivian Dennis with the Investing News Network. Thank you for joining.